Well, welcome to our New York City Live Markets Happy Hour podcast. As I mentioned, this is a weekly summary of some of the key themes in markets. And as always, because at Moneta we focus on investment portfolios, we try to ask the so what question, i.e. what does it mean for investment portfolios? We're not just talking in abstract or academic terms, we're trying to bring it back to what it means. So I've called this particular week blocking and tackling, as it does seem that we are continuing to deal with a barrage of news flow, geopolitics, domestic politics. We're talking about oil price. We're looking at a lot of changes, policy changes around interest rates. We're still dealing with affordability and with inflation concerns. So there seems to be a lot that we're trying to just deal with piece by piece and not often have time to step back and sort of think about what this means in holistic terms. But as always, we have 5 topics that we cycle through: inflation, interest rates, equity markets, geopolitics, and other asset classes. We touch on things like gold, Bitcoin, not necessarily because we recommend investing there, but because we want to just frame what's happening in these asset classes as a way of reading what's happening in the global momentum of what investors are thinking. So I usually have some in sub-themes, and one of the sub-themes around inflation data. We are seeing a lot of inflation data, but can we trust it? I think that's a question. There seems to be a narrative that inflation is trending down. Does that actually resonate with people here? Does it resonate with what consumers are experiencing? We're looking at interest rates, and we've had a lot of discussion of interest rates this week. Not only did we have the news last week about a criminal investigation of the Fed chairman, as well as the impact that because rates were not being lowered fast enough. Now we have a discussion around some interventions to drive mortgage rates down, and equally a discussion around credit card interest rates and capping them at 10%. And all of this are gestures in a way to try to drive affordability for the consumer. But what does that mean for, say, the financial sector, for the health of the economy more broadly, if we do start to tinker with some of these things that have been in place for some time? We've spoken before about 2025 being a defining year for metals. And clearly in 2026, metals mania is continuing with gold, and some of the fund managers represented here, I think will be thriving from some of the metals trading. But it's certainly been a big factor. And then I call this half-life happenings. What it really means is some themes in tech their half-life has become a lot shorter than we would have thought. And an example of that has been Meta's decision to close down some of its metaverse virtual reality segment and switching their efforts and focus onto AI now and wearables and tech. That was a very short-lived dalliance with virtual reality, and we wonder, well, will other trends be as short-lived? So we'll start with inflation, and I think it's important to really, this is where I find interaction with a live audience is important, because I can ask, is there a dissonance or at least a disconnect between what we're seeing in the numbers and what we're seeing in terms of the actual experience on the ground? What we can see is that we have food prices have been more suppressed, at least in terms of the inflation factor. But I would suggest that there's actually quite a bit of inflation already built into food. The consumer's experience around buying food seems to be that it is still quite inflated. So basically, the core point of these slides is that the inflation is back to target. I think, even from a distance, we can see that these slides are coming down. Core services seem to be leveling out. And that's basically, there's a suggestion that we have this now in hand. My observation is that this is quite different from what the average experience on the ground is like, the average individual, whether it's the person at the low end of the K-shaped economy or in the middle. It seems that prices are simply being experienced as a pain point. I'd love to ask here, people in the room, if there's anyone to chime in. But do you find a disconnect between this positive story on the one hand around inflation, the experience on the ground? And one of the questions I usually ask is, well, have companies actually pushed through the tariffs to date, or have they been absorbing it, and is the transmission effect going to be slower?
I think in my experience, the prices continue to be elevated, and they are felt at the local level for sure. I think in New York City, at least, when eggs were priced at $12, and that's not the case any longer. They haven't exactly made it all the way down to where they were a few years ago. If that's an example of where prices are, Dining out also very expensive. Like I think a lot of people are staying home because the numbers are kind of silly at some point. So I've seen it. I was just recently visiting family in Miami. Same story down there. And admittingly, these are major urban metropolitan areas. So maybe it differs in a more rural setting or a smaller town setting. I don't think so though. For my travels bring me to the Midwest quite a bit, Columbus, Des Moines. And you're hearing kind of the same thing coming out of the books there as well.
Yeah, it's a great observation. And actually, now that we're in New York, maybe we should bring it back to New York being really at the forefront of this affordability crisis and affordability topic. It seems that the mayoral election, this affordability rose to the top. It resonated. It captured the imagination of the voting population. And it seems now that affordability is being thrown into every press conference from both sides. Efforts that we will talk about later being made to drive that affordability. Yes, maybe any comments on that? Do you think that is a turning point, New York City, in terms of the affordability of the mayoral election? Is it a turning point? Did we just perceive it? I don't live in New York City. You do. Do you think we captured the vibe on the street, or was there something that was maybe misconstrued?
I don't think that it's a turning point yet. I think that it's early in the administration and that there has to be more time for events to play out, for decisions to be made as to how people view the whole situation.
Well, it captured the imagination of the world onlookers, I think, in terms of as far as that was concerned. So then we often do, after we move on from the inflation discussion, is look at the economy vibe check. And in terms of the vibe check, what we've seen is there has been clearly, when it comes to the employment, that it's been weakening but not collapsing. And I think we've all been under the entire question: can we properly actually understand these employment numbers? Are they real? Have they been revised? There doesn't seem to be a ton of concern about employment, which is perhaps why the Fed has been not lowering rates, because they've seen inflation still, they've seen the economy strong, employment relatively strong, and they've therefore not done anything. But it does seem that the employment picture, despite what we hear about AI, is still holding together. And that's something that, probably is, I think, evidence that we really cannot trust the data to the same degree that we have in the past.
Yeah, I agree with you. And I guess I would say there's a meaningful disconnect between maybe the numbers and the sentiment, right? I think that's where the divide is. I think people are perceiving these moments in negative ways, irrespective of positive numbers, right? And are not acting accordingly.
Yeah.
There you go.
Yeah. Well, that's exactly what we've been finding, is that the sentiment has been much more negative, not only whether inflation, around affordability, but also employment, as well as AI replacement of jobs. There seems to be that factor there when it comes to the economy. And so far, if we look across the board in terms of vibe checking, if we look at Europe, US, there hasn't been a ton of recession worries building up. There seems to be that was in the distant past. That was 23, 24. We talked about recession. Now there's this concept of a red hot economy that seems to be absolutely permissible to run an economy red hot, that there are enough checks and balances in the system, that they're with the Fed on hand to inject stimulus, as well as perhaps some fiscal stimulus on hand. There doesn't seem to be concern about red hot. All of us have been in the market for some time in terms of cycles. We've seen Asia, we've seen Europe, we've seen crises starting in Asia elsewhere. I think that it does lead me, at least, to have concern when anything is deliberately being thought about as red hot. The continuing metal focus has been, we talked about it last year, but there is, I would say that the gold, silver, and copper reaching records, there seems to be a very much a mixed set of signals that is driving that. On the one hand, there's this experience of the growth and spending, which would drive metals as a source of that, particularly copper. On the other hand, the concern around budget deficits seems to be factoring into this desire to debasement of currency to hold gold at that level. The silver behavior of silver has been really a lot more, even more pronounced than gold. And we did see at the end of last year this movement in silver, which was really factoring in that there probably were levered positions out there. there was probably a lot more, as was built a risk inherent in silver, more thinly traded metal than gold. But clearly, we need to focus on metals because I think it's sending a mixed set of signals. And again, someone in an asset manager who will actually trade metals. Is there any insights in terms of whether this is likely to continue all through 26?
We're seeing a lot. We're seeing exactly what you're saying. And I think from an institutional client side, this trend began maybe even a year and a half ago, probably, where they are increasing more exposure to metals, broadly speaking, as an inflation hedge or otherwise. Right? Mm-hmm. And so this began a bit, and I think it's just kind of remained. Yeah. So I don't see it going anywhere anytime soon. But you're seeing increasing more allocations from an institutional portfolio perspective in this space, where that wasn't always the case. Yeah. And so I think the portfolios are getting increasingly more creative as it relates to this particular space, both on the public and the private.
Yeah, that's fascinating. I think we would also have at a Moneta investors wanting to get maybe a piece of the action of gold. Mm-hmm. But what we often find is that it can be accessed through a public fund that would have, say, gold positions. Less so on the private side in our case, but we do have other ways of getting exposure to, say, this energy theme that may be behind some of this, as well as other themes. But I think this is going to continue, and it's sending signals, as I said, about that mixed perspective around the concern, which is again this dissonance that's been in markets before. Some of the other themes, clearly, we've talked about interest coming up over and over again. The one coming off the end of last week, we know that the Fed was on the fence about whether to cut rates that time or not, around its December rate cut, which they did do, but it was not a unanimous decision. Now there seems to be a more kind of a spanner thrown, a wrench, I suppose, in the works in terms of this recent Fed allegation of criminal investigation, because it now seems that this may have upended the calculus in terms of how long Jerome Powell is likely to stay. Suggestions recently that he will now stay beyond his chairmanship. He will stay as the governor to 28. If he stays as the governor, he's likely to have more influence because of his previous chair role. And he is a moderating force, I think it's safe to say, on the Fed. He has been through many cycles. He's tried to do the right thing. I think he's tried to remain independent. And that, I think, despite markets favoring rate cuts, I think there's a strong part of market watchers which really do favor an independent Fed that is making decisions based on objective facts and is not trying to deliver an agenda. So I think actually, despite the fact that this video was probably unprecedented by the chairman, there seems to have been the fact that markets haven't reacted greatly to that is a sign, I believe, that they actually quite like that back and forth, because it does give a sense of balance returning to the system. I
agree with that. I think when I saw the video come out, and then the next day, obviously, you were looking for reaction, and it was fairly muted. That was exactly the thinking. It's like, I think the market is not reacting because they probably like this kind of balance back and forth, and that's maybe perceived as healthy at the moment. And so there wasn't a like, oh my goodness, what's happening? The world is falling apart. Where this video being made by the Fed chair? It was starting actually.
Well, I think you're right. I think there is a sense that we can only handle so many unprecedented, imagination-busting events in a week, and I think there's a saturation point. And I think when there's a sense that, well, no, there is still a sense of check and balance, that can actually give some resolve. We have been scratching our heads at Moneta a little as to the enduring calm in fixed income markets. Bonds have not been reacting particularly strongly to volatility, to a red hot economy. They have not reacted to private credit, to areas of the sense of bankruptcies afoot or defaults afoot. Some of the other vibe checks here, besides the Fed being split, we saw that markets were a bit weaker this week. Clearly, the geopolitics, the temperature is rising at the backdrop, and that is adding to the uncertainty. We know that there has been, in terms of the immediate aftermath of that Powell decision, the top left chart there was a sense that the gold had surged and the dollar fell. So that's exactly what we would expect. That's a classic safety trade, flight to safety. But equally, now that the chairman is clearly not going anywhere soon, even after his retirement, we'll see the odds of a cut now have come back down. So overall, markets have been a little mixed in this week, but I'd say there's overall that has been sort of, I say, familiar trend and good to see. This is always the year of the acronym, and we've talked about TACO, we've talked about MAGA. Now we're talking about Big Macs, which is the midterms are coming. And this was the typical. One could say that there's a bit of a rally in an election year, as there is that tend to drive markets positive. Certainly, there's a desire to pepper the news flow with positive outcome. But what is the dynamic in a midterm election year? It's actually the opposite. The average intra-year drawdown during midterm election year is 18%. So midterms are not the banner years that we might see in a presidential election year. This is, of course, an intra-year drawdown. We could still end up with a positive end to the year. But clearly, there's an element of selling pressure. There's going to be uncertainty. There's going to be a lame duck presidency potentially at the end of that. And that just creates more uncertainty. So this is, I think, at the backdrop. Now, of course, this year could be different. Certainly, there have been many, the precedents have been burst through in terms of the equity market performance up to now. But I do think that watching the midterms coming, it's why we're seeing this particular flurry of activity, policy change. Any other thoughts on political expediency driving some of the policies?
It's hard to digest the news flow, as you mentioned earlier, for sure. I think it's interesting, again, in client conversations, folks talking about kind of the slowdown of the U.S. market, potentially, the emerging market has finally reached its heyday. Mm-hmm. There's a little bit of that data kind of flowing through the system, kind of early days still. Betting against the U.S. never feels like the right move, and it certainly hasn't been the right move over the last 10 years. No. So we'll see what that looks like. But we're, those of us in emerging markets are observing closely. Yeah. And seeing a renewed interest in the space, whether it be equities or fixed income. So I think that's kind of the other dynamic. I want to be clear, no one is backing Trump in any respect and betting against the US. But these are conversations that even a year and a half ago, we just weren't having, right? Because we were on fire. And we continue to be on fire.
And we do, and I think we have to remember the motivation in news organizations is to write headlines. Yeah. So when a single pension fund says it's de-emphasizing U.S. tech, if something means trimming its gains, that does not mean a wholesale backing up of the truck. I think that's important to actually understand what that means. I'd say one of the things when I discussed this morning on Bloomberg was around margins and just how incredibly sustained and robust and almost inassailable U.S. margins have been. Their margins in the US companies are a lot higher than you'd see in Europe or Asia. And equally, the earnings forecasts have just been, it says here on this chart, on a tear. But there have been, I think, a consistent beating of expectations. Well, they've been well-managed earning forecasts. But the question being, how can these companies, with the threat of tariffs on the one hand, sustain these margins? And my answer to them this morning was cost cutting. That they have been very, I'd say, preemptively and not hiring. They have been able to perhaps cut costs in other ways and know that they, as leadership, as CEOs, are getting rewarded for it. So clearly, when that incentive is there to drive earnings and drive returns that way, they've done it. They've spent money on IT, but again, they get rewarded for that. So I'd say this is again the other counterpoint to why should this year be any different is this year might be a correction in U.S. equities. It's just you can't really argue with the earnings forecast. This gets back to our point about rethinking American exceptionalism. I think this is the headline I took is exactly the headline that I mentioned, actually. Fund managers preparing for a reckoning in the U.S. tech sector. I think that was probably an exaggeration of their actual position, as I think they simply taking profit does not mean that you think there's a seismic event about to call a reckoning. But equally, the days when currency, equity, and bonds fall simultaneously, that is a measure. That this is again a stat that's looked at by Investment Strategy Group and Haber Analytics. They've looked at it where that is generally a sign of lack of confidence in a country, in a market, when everything falls simultaneously. And what we can see here is in terms of where the US sits here, it's been declining in the US and is substantially below that of France, Italy, the UK, and Japan. So overall, the US has had much less fragility, I suppose, attributed to it by investors, and whereas each individual, France, Italy, UK, and Japan have had their own reasons for looking fragile. But I'd say that the indicator for US exceptionalism still seems to be pretty strong. Coming now to outside the US, what we know is that these banner years have been happening outside the US and Japan and China, driven by quite different reasons. In Japan, it's been confidence in the new prime minister, a sense that she's serious about her reforms. She's going to election in a few weeks. That's again a sign of conviction, and I think a sign of confidence that she will get through. Moving then to China, China's export and import growth has really taken off in December. And I think which this illustrates for us is that the trade war, such as it is, has actually, there's been a real resetting of alliances. China has successfully formed other alliances. We know that the US does not represent much in terms of its the exports to China. They've fallen by 20% last year. This is the chart on the right. Shipments to other areas have remained resilient. Africa, ASEAN, and EU. We were just discussing last night how the China-Africa alliance has been so particularly strong, and that it's really the US is now China is blaming the US for trade imbalances as its surplus has hit a record. So clearly, I've also seen slides about China's electricity generation and potential, and just how that has soared. So we do know that this trade situation is panning out differently, perhaps, to we might have expected. And that certainly, if we look at going back to that chart in terms of China's performance from the last year, there has been a steady performance of China and Japan, certainly. So it's been a good time to be a global investor, certainly of all accounts. Moving to the other region, developed markets, in terms of Europe, I thought this was an interesting, and this gets back, maybe I'll turn it back to some of you to think whether words matter. Because with Venezuela, there's been a lot to digest. We've had Venezuela on the one hand, we've had Greenland, overtures around Greenland, and building up of preparatory defenses there. We've also had the Iran situation, and we've still continuing to have Russia, Ukraine, and other Middle East conflict backgrounds. So I would say this is, I wouldn't say it's unprecedented, but it's certainly a strong level of geopolitical chatter and noise. The statement by Stephen Miller, Deputy Chief of Staff, that we live in a world where you can talk all you want about international niceties. We live in a world, in the real world, that is governed by strength, that is governed by force, that is governed by power. Whether these are words, clearly, but those words were particularly latched onto by media, by social media, as really just setting that power is the way. And I think this is, love to know what you think, whether this has changed anything. But equally, when it comes to power and might and military force being the dominant and what matters, this has obviously very interesting collateral effects or consequences, particularly in Europe. And I'd say what this is happening for Europe is there is a new dynamic afoot, where ironically, this happened also with the Russia invasion of Ukraine. Something that is designed to fracture something can often have the effect of strengthening it. So it seems that if we're now talking the language of power, no single European nation can even hope to compete. I mean, even though their stock markets are the size of a single stock here. So that's indicative of their economic might, which sometimes corresponds with, and often corresponds with, military might. There's a sense of the quote about Europe saying that there are some small countries, and there are countries who don't know they're small, but they're also small. So there are a lot of small countries in Europe, and that this power language coming out of the US may actually have the effect of strengthening some of the commitments in Europe to each other, to NATO, to their neighbor Denmark. And equally, we know that defense spending has been strong. I'd say if you look at this chart here, we're still seeing some flows into Europe. This chart shows flows in from abroad. China has been, as we know, persona non grata on the investment stage, having been uninvestable. It hasn't had much interest. US has had a huge amount of interest. But the Eurozone has not had no interest. If we look at it over the past, since 22, there's been a steady rise of flows into Europe. So I think this is a new power dynamic for Europe that we will see playing out, but I don't think it's playing out in short and slow motion. I actually would argue that it's playing out quite quickly. And the interesting part here is, and this is not even the next point around, not only around power, but also around fundamentals of democracy. The attack, when even the populist politicians will know this, that the one thing to galvanize support is to attack something and to create a common enemy, that the perception of being attacked is a way of galvanizing support against that. So when it comes to democratic principles and the desire to actually, fundamentally defend oneself. These are all things that have been galvanized by some of the attacks on it. So it doesn't necessarily you always translate into stock market returns. But here in this case, we can see that the obviously defense stocks, whether it's Siemens, Rheinmetall, Leonardo in Italy, all of these stocks are having banner years, and there will be a spending that gets attached to that. So I think we're not always getting a lot of attention on these things. Just moving to some of the last topics, just conscious of time here. So in terms of, I mentioned this idea of all things clubbing over before they've even begun. I have to say, having never really gone on the train of virtual reality, I wasn't utterly disappointed to see that the spending was now being shifted elsewhere. But I think this is a sign of just how much money potentially these large tech stocks have to kind of dapple in areas that they don't even have to have proof of concept. So clearly with the metaverse, there was never really a proven mass adoption, proof of concept. It was a kind of a privilege for a few to play with this area, but it never received critical mass. So now it's AI devices. So I think this is a cautionary tale for some of what we hear is the next big thing. Let's not forget that Facebook changed its name to Meta based on its belief that the metaverse is where we would all inhabit going forward. So now that's kind of yesterday's news, and now we're shifting to AI devices. So I think just watch this space in terms of trends being shorter than we think. So I think that is the end of prepared remarks in terms of what's been going on this week. There's been a lot to contend with, and I think as far as the investor's standpoint, the investor is balancing this red hot permission slip on the one hand with some of these nagging concerns which have not gone away, but we yet are not rising to the headline level. So there is, I believe, a need to still pay attention to them and be worried about that red hotness, but take this opportunity to diversify broadly and to stay with global exposure, given where that has been proven to be beneficial. So before we stop recording, any other thoughts, questions, anything on your mind that is sort of keeping you up at night as participants in the market?
Where do you think the AI trade is headed this year?
That's a great point. I think broadly, we will see probably less outperformance by the top tech stocks. We've seen already them be the lion's share, but if you actually look at what were the top performers over last year, they were not some of the top performers. Some of them had strong performance since Liberation Day. So there's going to be more and more. There'll be some attempt to get to IPO, whether it's Anthropic or OpenAI. And that will be, there'll be this mass kind of dressing up of some of those stocks in the rush to IPO. And that dressing up will probably be a kind of almost like a pre-election in terms of making things look pretty. That's on the private side. So I do think that will cause quite a lot of excitement when one of those goes to IPO. In terms of where we prefer to be, it's more on the picks and shovels in the infrastructure side, the data centers, the energy, things that are less exciting perhaps in terms of the stratospheric rise, but are still very necessary. And in a way, they have locked in contractual arrangements, which will probably sustain their cash flows. So I don't see, but what I think is important, but I don't know how it's going to work out in the trade, is this moral pushback, this ethical pushback. Whether that will be in this administration, will it get attention, or will it be something that gets kicked down the road because there's a strong tailwind for AI with this administration?
What about sustainability? We've seen obviously headwinds, not tailwinds, in that regard with the new administration. How do you see that playing out in India?
Surprisingly well, actually, because if we look at green energy in 25, I think it's up 40%, that index, surprising return, actually, given where the pushback was. Oil prices coming down, but equally, the reason we know the oil has been struggling, the oil companies have struggled because the price is down. It doesn't make all of this oil in Venezuela look very attractive if the actual price of extraction is lower than the price that could be sold at. So that, I think, is kind of making some of that question mark. And equally, we do have a lot of supply in the US. We are energy independent. So I think the fact that the oil price is down is actually, but yet other sustainable forms of energy are still needed. I think there will be less incentive perhaps to develop that oil, and as much incentive to look at the solar farms, wind farms. We know China is just playing on all angles for electricity. It's not just the so I think there will be development of that. So I'd say it will do well, because of the way if it makes sense from a capital standpoint, it will still do well. Well, great. Well, thank you so much for coming and contributing. And thank you for listening to our Markets Happy Hour podcast.